Hello, I'm Peter Herbert and welcome to today's session on going concern. During the last bite-sized financial reporting session that we ran, we talked in quite a bit of detail about post-balance sheet events. I think post-balance sheet events and going concern are the two key issues at present, and that's why today what we're going to focus on is going concern. Let me start, if I could, by sharing my screen with you. Okay, so going concern, let's have a look at the agenda for today's short session. So we're going to start off with a very quick recap on post-balance sheet events from last time, how that links into going concern. Talk about basis of preparation and compare going concern with what we sometimes refer to as gone concern and the impact of that for the balance sheet. Think about making the going concern assessment. Think about getting the disclosures right, and finish with some very specific considerations for charities. Okay, let's begin with that post-balance sheet events recap. So, as discussed last time, post-balance sheet events occur between the year end and the date the accounts are signed. Adjusting events provide evidence of goodness in place at the year end, and non-adjusting events are sometimes referred to as out of the blue. And from the year end accounting point of view, it's disclosure only. What of course happens though, is that when a post-balance sheet event affects going concern, that adjusting, non-adjusting distinction is completely blown out of the water and we adjust anyway. And that's the key link, I suppose, between the post-balance sheet events rules in FRS 102 and the rules in relation to going concern. Okay, let's think if we could about basis of preparation. I always think that the chance of an entity not being a going concern is quite remote, because FRS 102 defines going concern thus: an entity is a going concern unless management either intends to liquidate the entity or cease trading, or has no realistic alternative but to do so. So that is very unlikely going to be the case. I guess the way I've always thought about it is, if you're in a situation whereby you're not a going concern, given we got in the UK a filing deadline 9 months after the accounting year end, more chances than not really that what probably will have happened by the time that filing deadline arrives, the company will have been liquidated anyway, and therefore no accounts will be required. So it's much more likely in reality that an entity will be a going concern. However, there are rules. You may remember that in the old UK GAAP days, pre-2015, we used to talk about the breakout basis of accounting for an entity that was not a going concern. And that probably would involve things like reclassifying fixed assets as current, reclassifying long-term liabilities as current, providing for losses that were anticipated from the year end up until the point the company was effectively wound up, and also including assets on the balance sheet as a kind of a fire sale valuation. Now, under new UK GAAP and FRS 102, there's no such thing as the breakup basis. In fact, there's no reference at all to any other basis than the going concern basis. So I think what we tend to say these days is that you wouldn't be looking necessarily to reclassify assets in the event that an entity was deemed to not be a going concern. You certainly wouldn't be looking to make provisions of future losses. You would have to think about marking assets down to their recoverable amount. But yes, there's less detailed rules really now than there was, and probably reflecting the fact to a greater extent that the going concern basis, as already mentioned, will be relevant much of the time. Okay, let's think about making the going concern assessment who and how. I guess the default over the years in terms of assessing going concern has been based on projections. I do know, talking to people that work within firms though, it's really hard in the real world to get directors of companies to do cash flow forecasts to actually come up with a realistic assessment of how the going concern principle applies. But yes, in theory at least, those cash flow projections are really integral. And of course, we are looking forward, aren't we, 12 months from the date the accounts have been signed. I think in the current climate, projections will become more important than ever, for no other reason, I suppose, than to keep the bank on side. I think given that we're in a very different world now to where we were pre-COVID, I can certainly see banks lending a lot more on the back of cash flow forecasts than historical financial information. So from that point of view particularly, I think forecasting will become a really key thing. In that context, we always talk, don't we, about the merits of things like sensitivity analysis and scenario planning. I do appreciate in the current climate that's going to be a very important thing to do, but a very hard thing to do when we're looking forward at the time of recording this particular session in April 2020 and see a very uncertain world in front of us. But that, I think, is something which we would certainly commend to directors of companies to help inform that whole process of planning in the future. I wonder whether maybe in the current climate, though, there's maybe some merit in perhaps thinking big picture about forecasting rather than too much detail. So difficult is it to predict really where we're going to end up being. I've always thought about the merits of the 80-20 rule in the context of forecasting, in the sense that if we assume that 20% of our customers give us 80% of our turnover, if we focus from a forecasting point of view on those 20% and what they will deliver, the remaining customers that bring in less revenue, probably from a forecasting point of view, will take care of themselves. So a few thoughts there on forecasting. I think it will become really, really integral to the future. One concept I've certainly come across a couple of times in recent weeks that I think may become more common in SME businesses is the concept of reverse stress testing. And the way that reverse stress testing works, as I understand it, is you think, well, okay, what could happen to my business to cause it to fail, to cause it to fall over? And that could, I guess, be, if lockdown continues for another 2 weeks, 3 months, 5 months, and I can't trade, my business will absolutely fail. So what will be the triggers for your business actually failing? And then as part of your business planning process, what steps would you put in place in the event that that occurrence were to happen to try and survive and not find that your company's failing, despite the fact those restrictions will remain in place for a period that you ordinarily would consider to be just too long in order to survive. And that's something we might see more of as a concept coming through, certainly in future weeks, linked to the whole forecasting process around going concern. Now, for the Chartered Accountants Monthly, there's some quite good resources you can tap into. The ICW has issued a really good working capital checklist resource on its website. Very good for practitioners, very, very good indeed for practitioners' clients, to give them a sense of how working capital management and forecasting can be really helpful in the current climate. And what they link into in that particular paper is an Institute report done in December 14 to do with smarter business planning. And some really good practical tips in that paper for business planning generally and forecasting, which, as I say, are really relevant issues, I think, for many organizations in the current climate. Okay, we've talked about the post-balance sheet events linked to going concern. We talked about the basis of preparation. We talked about making the assessments. Let's now move on and think about getting the disclosures right. Let's just give a quick summary of the basic scenarios you're looking at in terms of disclosure. So the first scenario, which you've already alluded to, is where an entity is not deemed to be a going concern. What you're required to do per paragraph 3.9 of FRS 102 is disclose the basis of preparation in the financial statements and explain why the directors are concluding the entity concerned is not a going concern. Now, that, as I've already mentioned, I would imagine would be pretty rare in practice. Scenario 2, I think, is more common. So where there's a material uncertainty that casts significant doubt on going concern, again, paragraph 3.9 says that what you've got to do is basically disclose those material uncertainties that give rise to that significant doubt. And in the current climate, I would say that's going to be quite a common occurrence. Where there's some uncertainty but not material uncertainty, there's no obligation based on FRS to incorporate disclosures, but it might well be that some additional disclosure might help to what I would call head the reader off at the pass and just reassure them that although the accounts might in some ways look a little bit sorry, that in reality, this does not necessarily mean there's a material uncertainty that casts significant doubt. And what I often refer to on courses in that particular regard is a very helpful paper that the Financial Reporting Council put out back on April 16, all about guidance for directors on going concern. And what they advocated in that paper was, if there is some aspect of the accounts that might give the reader some worries, maybe, for example, a balance sheet that's got net current liabilities, don't be afraid to slightly over-disclose to reassure the reader of the accounts that despite that slightly concerning feature, there's not in reality a material uncertainty that casts significant doubt. So something I've been talking about a lot in recent years, and very relevant here now, I think, certainly in the current climate. Where there is no uncertainty regarding going concern, then per FRS 102, no disclosure is required. Okay, a little bit of a deep dive on a couple of paragraphs. So paragraph 3.9, I've already made reference to there, where there are material uncertainties that cast significant doubt. The other one to be aware of as well that links in, I think, here is paragraph 8.7, that requires disclosure of key assumptions concerning the future and other key sources of estimation uncertainty that have got a significant risk of causing material adjustments to the next year's balance sheet. And I guess in the context of the current climate and going concern, key assumptions that underpin forecasts that in turn inform that going concern assessment could very much be the key assumptions you might want to refer to in this area to comply with paragraph 8.7. So that's worth thinking about as well. We're always very keen to encourage people to avoid too much general and what we might call boilerplate disclosure around things like going concern and for that matter post-balance sheet events. And certainly thinking about what the specific key assumptions are per paragraph 8.7 and explaining them would help you move away from a boilerplate approach and ensure that your disclosure is more tailored to the relevant circumstance. Now, we've had quite a few queries recently from firms saying, have you yet devised a standard going concern wording for a set of accounts, for a set of notes to the accounts that we can pop into our clients' accounts to comply with GAAP? I guess what we're kind of saying here is that in no way, shape or form will we ever say there's a standard wording you could use. Clearly, it'll be relevant and depending on the particular circumstances. So appropriate tailoring to reflect the requirements of these paragraphs, I would say, is what we'd always advocate people who ask us questions about that. Now, that being said, here's a recent example of one that I was asked to look at for a firm. I think from the point of view of paragraph 3.9 of FRS 102, this kind of does a job. The feedback I gave here was to be as specific as you can in relation to the organisation's circumstances. And yes, if there are specific assumptions regarding the future that are being made that are informing that assessment, don't be afraid to articulate those in that note rather than making it too general. I guess as we record this session in April 2020, because the future is so uncertain, we might well find that these paragraphs in the short term are quite generic, aren't massively informative. As we move through 2020 and we get a clearer steer on where things are heading, it may well be that we've got a clearer sense of what those key assumptions are, and therefore these going concern disclosure notes can be more informative for the reader of the accounts. One or two follow-up questions from there. So what about accounts prepared under section 1A of FRS 102 for small entities? Well, I think for those, I would very much advocate that you do for a small entity under 1A what you would do for a medium or large entity under FRS 102 more generally. Don't forget that in Appendix E of section 1A, one of the disclosures that the Financial Reporting Council strongly recommends that's included is any relevant disclosure regarding going concern uncertainty, even though that disclosure is not formally a requirement of the law. So I would say based on that, do for a 1A entity what you would do for a normal, medium or large entity under full FRS 102. Question 2 there's no requirement to incorporate disclosure around going concern uncertainty in a set of accounts for a micro entity prepared under FRS 105. Now again, you could do, but don't forget that the very minimalist approach taken by FRS 105 does result in accounts which are deemed to be true and fair. So from that point of view, yes, no obligation there, but you absolutely could. And that again, I guess, could be informative for the reader. It may well be, question 3, that additional disclosure will affect the client's credit rating, but welcome to the new world, really, of the UK in a COVID-19 era. I think we're going to get lots of these disclosures in accounts in the short to medium term. And I think it's on all of us to educate banks what these disclosures actually mean and why they're so prevalent. But it will have an impact, but they are going to be there. It's just really, I suppose, the nature of the beast, really. It is where we are in the current climate. And certainly in terms of audit report, I'm not going to get massively into audit today. This is more of a financial reporting session. But if you do audits, don't forget that where there's a material uncertainty that casts significant doubt on going concern, you need to make specific reference to that within the going concern section of your audit reports. And that I know is really unpopular. That's something I know that clients will push back on massively to try and avoid that paragraph going in. But that, again, I think in the short to medium term will be the nature of the beast, because accountants and auditors alike will conclude there's a material uncertainty that casts significant doubt on going concern, and that will therefore trigger the audit report disclosure that we're referring to here. Okay, let's look at the final section then, some specific key considerations for charities. I think from a charity point of view, these are very, very difficult times, and therefore I think from a charity point of view, going concern is definitely going to be a key issue. If you do get involved in financial statements for charities, don't forget the Statement of Recommended Practice, or SORP, does generally impose more onerous disclosure requirements around going concern anyway. So yes, from the point of view of charities, where there are no going concern issues, you do still need some going concern disclosure in the notes to the accounts. Where there are material uncertainties, you need to make specific reference to those material uncertainties in the trustee's annual report as well. So there were already more onerous disclosure requirements for charities, and clearly in the current climate, those disclosure requirements in the SORP will require careful consideration. Implications for independent examiners in England and Wales at least, and auditors. So yes, going back to my earlier comment, where there is a material uncertainty regarding going concern for a charity that casts significant doubt, that will definitely get referred to in the audit report, and from an England and Wales independent examination point of view, will get referred to in the independent examiner's report as well. So important implications for them, where they conclude there's a material uncertainty that casts significant doubt on going concern. And don't forget that under the charity regime that existed this last couple of years, that when an auditor or an independent examiner modifies their opinion or includes an additional explanatory paragraph in the report dealing with something like a material uncertainty regarding going concern, that will also automatically trigger a report of a matter of material significance to the charity regulator in the relevant jurisdiction. So that additional reporting obligation is there as well, that you wouldn't get for a normal commercial entity. Now, there's some great guidance around for charities and their accountants and their auditors and their examiners. The two points of reference on this slide, so the Charity Commission guidance, COVID-19 guidance for the charity sector is good general guidance about some of the implications of the current situation and how that impinges on charities. Some very helpful guidance as well on the Charity SORP website about specific implications of COVID-19 for the control, internal control within charities, and also specifically with charity financial reporting, including some comments around the link to post-balance sheet event disclosures and going concern disclosures, as covered off in this particular bite-sized session today, and the one we ran recently. So some good points of reference there in relation to charities. Do have a look at those. Okay, so that wraps up this short session. Let me just give you perhaps a few final takeaways maybe from what I've been talking about. So I'm thinking about the fact that the most likely issue for entities in the current climate probably will be there'll be a material uncertainty that casts significant doubt on going concern, which therefore requires disclosure more than there being an issue whereby an entity is not a going concern. It's quite extreme and quite unlikely. It therefore probably will certainly for many entities be more of a disclosure issue. We've talked about the fact that paragraphs 3.9 and 8.7 of 102 will provide some inspiration there for what that disclosure might look like. We talked about the fact that it would be very much best practice, I think, to apply the sort of spirit of those paragraphs in drafting a set of accounts for a small company under Section 1A of FRS 102, as well as a medium or large entity applying full FRS 102. We've talked about the importance of avoiding boilerplate disclosures, and might at the end there mention there's some additional specific challenges for charities and signpost some useful guidance from the Charity Commission and from the Charity SORP Committee. Hope you find that useful. If you've got any queries about any of the points I've raised in today's session, do drop me a note at inquiries@insight-training.biz, or if you want to get a copy of the slide deck, do again drop me a note and we can more than happily provide that. These bite-sized webinars are also available for download through www.onlinetutors.co.uk. That's a good website to have a look at as well. And what you'll also find there is some really excellent tax content dealing with the current situation recorded by Dean Wooden. So some very good stuff there on tax, if that is of interest to you as well. Do go and have a look at it and do download it. All free resource. Okay, let me just quickly here stop sharing my screen. So thank you so much for listening. I do hope you found it useful and look forward to speaking to you again soon on another bite-sized financial reporting webinar. Goodbye.